Welcome to the show where we share the stories of the many who intersect with our healthcare system but are rarely heard from. My name is Kevin Poe, founder and editor of Kevin MD. Today we welcome back on the show Noah Kaufman. He is an emergency physician and financial planner. He is founder and CEO of the Kaufman Medical Group. He came on the show approximately 1 year ago and told us everything physicians need to know about Bitcoin. He's back on the show today to give a general cryptocurrency market update. Noah, welcome back on the show.
Kevin, great to be here. Good to see you, my man.
So we'll talk about crypto in a little bit, but for those who didn't get a chance to listen to our first episode together, just briefly share your story and journey to where you are today.
Absolutely. Well, I'm 46 years old. I went to medical school at Tulane, did my residency in Ohio for emergency medicine, and I've been a full-time practicing EMP since 2006 when I graduated residency. And I've always had an interest in finance, and I've always, as with a lot of ER docs, had quite a bit of passions outside the emergency room, and of course, titrated my exposure to medicine to try and keep burnout low. And so I've been a competitive rock climber. I've been on TV. I did American Ninja Warrior, a show on NBC for 7 seasons, was not talented enough to win the $1 million. I do have a Series 65. I've always loved finance, like I said, and I've managed money and I've learned everything that I could about the financial system and money itself. I love philosophy. I love chess. I play guitar, and I have a 10-year-old son named Zun, who I'm extremely proud of. So that's me in a nutshell.
So before we talk about the current state of cryptocurrency, just tell us, what role does cryptocurrency currently play in your life?
Yeah, absolutely. Well, I would say that currently cryptocurrency in general, as a nascent asset class, it just fills me with philosophical, wonder. It's not very often that a whole new asset class is created. We have precious metals, we have bonds, we have equities, we have real estate, and we have, of course, have precious metals, like I said, but these have been around for eons, and to have a whole new asset class now that money can be allocated to is really mind-blowing, and most people don't realize that to have a new pool that capital can escape to or speculate in or otherwise utilize, that's very, very powerful. And generally, these type of trends play out over decades. And so we're at the very infancy of something that is probably bigger than the internet itself and came about because of the internet. So I've always loved history. I've always been a student of the human condition. And as a practicing physician, I think all of us can identify with, the problems in the world, not only from a health perspective, but from a financial perspective, and our role in the medical industrial complex, which unfortunately does quite a bit of financial harm to people. And so I want the world to be a better place for my son, for everyone. I also have done very well investing, and I love investing. And it's something that I was always very good at. Of course, I've made mistakes, and I'm just as human as everyone else. But right now, cryptocurrency plays that central role of the thing that I want to learn the most about. As Wayne Gretzky said, skate to where the puck is going.
Let's expand on that metaphor where you compared cryptocurrency to the nascent phase of the internet. So speaking today in the beginning of February, where do you see cryptocurrency is when you relate it to the internet?
We're at the very, very early stages of adoption. Adoption of networks it's a very interesting phenomenon. It actually is mathematically described. There's a law called Metcalfe's law that states that every additional participant in a network, a social network, a monetary network, a retail network, a mobile network, whatever it is, adds an exponential value to that network. And usually networks are adopted along an S curve. And it starts out in the beginning very, very slow. And there's the extremely early adopters, and they come in. It takes a long time to kind of catch on. And it's that, tipping point phenomenon where all of the early adopters turn into mainstream adoption and then saturation of a market or the network. So we're in the very, very early parts. Cryptocurrencies are probably about 1% adopted, despite their kind of popularity in mainstream culture now and the constant talk about them. Very few people are allocating capital to these nascent asset classes, and when they are, it's very speculative. It's with a lot of trepidation and a lot of respect for volatility. And so we're at the extremely early phases of cryptocurrency adoption.
So like I said, we're speaking in the beginning of February, and I want to get your take on the general cryptocurrency marketplace. Bitcoin has decreased about 30 to 40% since its all-time highs, close to 69,000. I think it's currently something like 38, 39,000 currently. So just what's your general take on the cryptocurrency market today in the beginning of February?
Yeah, absolutely. Well, the cryptocurrency market can be separated into actually two new asset classes. There's Bitcoin, which stands alone as digital property, decentralized, distributed ledger that is incorruptible, immutable, and it's the most perfect money that the world has ever known. In fact, history will most likely show that money was invented in 2008, 2009, and that everything before that was a proxy and a simulation for money. So there's Bitcoin, and then there's the rest of the cryptocurrency complex, which is all the altcoins, every project, all the L1s, the layer ones, like Ethereum and Solana and and Polkadot and Cardano and all these things you hear about. All of that stuff gets lumped together, and there's like 10,000 coins. Okay, and then there's Bitcoin. And so the market cap of these, when you combine them, is about $1.6, $1.7 trillion right now. Bitcoin alone is about $800 billion. It has obviously passed the $1 trillion mark, but so the complex itself is very, very healthy. It's so small right now in terms of an asset class that it's just whipshot, it's whipsawed, it's taken violently from side to side by traders, by institutions. The price is very easily manipulated, and it's extremely volatile. And this is what happens with all new asset classes and all small market cap assets that institutional players, nation states, sovereign wealth funds, family offices want a piece of and want exposure to. And so when we look at the cryptocurrency complex, the asset class as a whole, what we have to look at is adoption rates and hash rate, like computer usage and participation in the networks, because these are networks, just like Facebook was a network. And we are in the Facebook of money, or the Amazon of money, because Bitcoin is a monetary network. The rest of the cryptocurrencies are a little bit different. We can get into that, but the whole thing, when viewed together, is growing at an enormous rate. The price really doesn't matter. It's extremely volatile. It has sold off 50%, numerous times in the last decade, and that hasn't stopped it from having a CAGR of over 200% a year. And so, it's extremely healthy. All the on-chain analysis shows that long-term holders are accumulating now. We're in a very interesting time from a macroeconomic standpoint. And what is the 24/7 most liquid, most speculative asset class? And that's Bitcoin. And so funds, when there's margin calls or when the equity markets are selling, Bitcoin is going to be the first risk-on asset to start getting decimated. And that's going to continue. And as it grows and matures as an asset class and goes from $1 trillion to gold's market cap, which is $10 trillion, and when Bitcoin is $500,000 a coin, it will be a little bit more stable. And then when it goes 20 times that, and it's or even 10 times that, when it's $100 trillion as a market cap, and it's considered a true store of value and reserve currency, then it'll be very, very stable, because then traders and hedge funds can't come in and put a $50 billion into move the market or spoof orders or do what they need to do. So if you're a long-term holder, which is really the only, I think, correct way to invest in this new technology, then it's, a fleeting concern, and it's something that really needs to be mitigated in the same way that you mitigate all volatility and all risk in any portfolio, and that's through position sizing.
So let's talk about some of the macroeconomic trends. The Federal Reserve is likely going to tighten their monetary policy. Some are saying 3 to 4 interest rate increases this year. How are these macroeconomic trends going to affect the growth of cryptocurrency?
Great question. So there's a lot of different takes from a lot of smart people. It doesn't matter how smart I am or how not smart I am. I've listened to all these takes. I have a good fundamental understanding of economics and what the Fed does, of the repo program, of quantitative easing and tightening of interest rates and relationships to equity markets and other markets, and the euro dollar system and the dollar's reserve currency status. I will tell you, nobody really knows, but the Fed is jawboning, and they're clearly jawboning. What jawboning means is they're saying things for psychological effect and then doing something else. Okay, so we know this factually. We know that inflation has a large psychological component. When higher prices are anticipated, people stack up on goods and services because their dollars are going to go less far in the future. We just had a 7% CPI print, which means real inflation is probably 10 to 15% or more. But that's the highest print CPI, the way the government measures it, in 40 years. We know that the Fed is saying one thing and doing another thing because they've been talking about tapering, and they're supposed to be tapering since November or December. And instead, what they've done is they've continued to purchase assets at an alarming and record rate. So I don't have the numbers in front of me, but the estimate was that they were going to continue to purchase assets behind the scenes through their special vehicles to the tune of about $470 billion in January. That was their estimate. Instead, they were up in the $750 billion range. So there is no tapering. And when they say they're going to raise interest rates, from my perspective, that's not possible. Because when Volcker raised interest rates in the 80s, you had to remember that debt to GDP was in a lot different place than it is now. We're at 130% debt to GDP. And I've gone back and I've looked at every historical case in every country. As a matter of fact, in the last 100 years, 51 out of 52 countries that have had a debt to GDP of over 130% have defaulted on their liabilities, on their debt. Japan is the only one that hasn't, and that's beyond the scope of this conversation. But suffice it to say, if the Fed were to try and actually raise rates like they're saying they want to, they wouldn't be able to service the debt. We cannot service the debt that we have with our tax revenues. And because we're in a very tricky spot, and the Fed is stuck between two horrible choices. They either default and cause a massive depression or a great recession, a very horrible recession, because unemployment will go up, stock markets will crash as they raise interest rates. And by the way, one of their primary mandates is to keep unemployment low. And so they either do that and destroy the economy, or they inflate out of the debt that we have, which is a much more politically palatable option, especially with midterms coming up this next year. So I personally believe that it's jawboning. They may make one rate increase. And what's going to happen is at some point the market is going to have a tantrum, and they need to step in and ease more, and they will print infinitely. And what that means is asset holders will inflate faster than everyone else. And you will watch this kind of everything bubble continue to grow. I mean, these are factual and very, very horrific times that we're living in. 40% of the dollars that were ever created were created over this last year. That is a fact. M2 has increased by 40%. That is nuts. And so now that the velocity of money which is how fast money is moved around the economy, has been improving, and people are spending, and the economy is getting hot again, and inflation is rising, you would think they would have to tighten, but we're in a unique situation where they can't. And for anybody who wants to read more about these types of situations, fiat currency systems collapse on themselves, I recommend reading Ray Dalio's work. He's a Harvard-trained guy who's the leader and owner of the largest private hedge fund in the world.
So let's talk about some of the criticism leveled against cryptocurrency. You read editorials, say in the New York Times, they say there's not a lot of use cases for Bitcoin. as a store of value because it's so volatile. Paul Krugman recently wrote an editorial last week, and I quote him: "I'm seeing uncomfortable parallels with the subprime crisis of 2000s. There's growing evidence that the risks of crypto are falling disproportionately on people who don't know what they're getting into and are poorly positioned to handle the downside." So from that last criticism by Paul Krugman, what's your response to something like that?
I mean, I think he's right in a way, which is probably going to surprise most people that I would say that. But look, we have to go back to the fact that there's Bitcoin, which is a pristine asset. It's pristine mathematical collateral. It's the first store of value that holds its value over time. You can transport the value of your money between time and space without any loss of its fidelity. And then there's the rest of the cryptocurrency complex, which is every single coin under the sun, 10,000 coins, and it's very .com-y, right? It's like most of these projects are, some of them are outright scams. They're probably all securities. Bitcoin, by the way, has been deemed digital property, protected under the First Amendment as code. It has no CEO, it has no team. Cryptocurrencies, there's 10,000, each one has a company behind it, and they're trying to make money, and these are probably securities and probably need increased regulation. So I think he's right. This is like the .com era. I'm not sure I would say the subprime era, because the subprime era was different in that we got out over our ski tips and banks started becoming very creative with how they packaged and sold debt with collateralized debt obligations. And again, outside the scope of this conversation, but happy to have that conversation. But, I think he's right that there's going to be a lot of people who are going to get decimated and annihilated. And that worries me quite a bit. And that's why you need to be educated in this space. And it's like the .com era. You had the biggest companies in the world, the most incredible new companies made. You had Amazon, Facebook, Apple, all these new networks that thrived in the internet land grew and went on to become the world's largest companies. But what happened to most companies? The pet.coms and like all these, they collapsed, obviously. Many of them were just, believe it or not, way ahead of their time. So I think he's right. But then we also have to remember that really smart guys like Paul Krugman and Nobel laureates, they are wrong. They can be wrong. And Paul Krugman famously said in the end of the 90s that the internet would be nothing more than a memory in the 2000s, and that it had no real use case, and that it was just a fad, and it would have the same, it would be like a fax machine. So, I think that I take it with a grain of salt. I do think he's right, and I think he's a brilliant guy who obviously cares about people's welfare. And I do think a lot of people have exposure and are going all in because they're feeling the pain of inflation, and they're seeing prices go up a lot faster than their wages, and that's difficult, and that pushes people out the risk curve. The whole bond market now is negative yielding. If that doesn't prove to really be transient, guess where that $400 trillion of debt is going to start going? It's looking for risk. It's looking for return instead of a negative 5% return every year. And so it's going to go into equities. It's going to go into real estate. That's why BlackRock is buying up real estate. That's why, China and Russia are hoarding precious metals and commodities. Well, the Bitcoin has also, and the whole cryptocurrency complex has also inflated along with those other asset classes as people are forced out the risk curve. So I digress, but is not wrong. He's a brilliant guy. He has, and we have to separate Bitcoin from the rest of the cryptocurrencies. And I think it's a more nuanced discussion than the blanket statement that he's saying.
We're talking to Noah Kaufman. He's an emergency physician and a financial planner. He is the founder and CEO of the Kaufman Medical Group. Noah, as you mentioned, one of the things that you want to do was educate physicians on cryptocurrency, and I understand you have a Substack that can do just that. Tell us more about that.
Yeah, thanks, Kevin. Well, we actually just launched in November, but myself and several other finance-savvy computer programming, other ER docs as an intensivist have started a Substack called CryptoPulse. It's free, and we educate. We're talking about Bitcoin primarily, but also about altcoins, about how to store your cryptocurrencies, about the history of money. I mean, it's all over the place. There's gifts. It's very educational, and it will always be, something that we want to bring free to our colleagues, because I think there's a lot of misinformation. There's a lot of perhaps disinformation out there, and a lot of kind of financial communities in the world, in our physicians world, and kind of in our colleagues' world, are very conservative and don't spend a lot of time talking about this new asset class, or if they do, don't spend enough time really thinking about it and educating so that people can make their own decisions. So Crypto Pulse is the Substack. It's free. You can find it through my Twitter. I'm Noah Kaufman, MD, 1F, 1N in Kaufman, Kaufman. So Noah Kaufman, MD. And I'm on Twitter Spaces quite a bit. I'm educating there. Yeah, sign up for Crypto Pulse. It's literally just a free cryptocurrency newsletter to get people educated so that they can make their best decisions for themselves. And of course, we have oncoming sponsors and whatnot. We already have 500 or 600 doctors who have joined us since November. So, it's a way to kind of pay back. Personally, kind of reached a point in my investing and trading where I don't care about the money. Luckily I have enough. I've been fortunate that it's not something I need to worry about any longer. And so now, what drives me is educating, and then also philanthropic opportunities. And I love helping other physicians, because I remember what it was like slaving away and kind of working extra shifts and stressing myself out for, to try and pay off my 6 figures of student debt. So I'd like to move beyond that. And then Dr. Palmer and I also, we do lectures to groups, and we're hired out for consulting. So, we do that sort of thing as well.
I'll include a link to your Substack in the show notes. What
Thank
role
you.
should cryptocurrency play in a typical physician's financial portfolio?
Well, it depends. It depends on risk tolerance, and it depends on a whole bunch of things. If you're allocating to Bitcoin, which should be the majority allocation, it's something that you would want to buy, and you would want to leave and sit there and sleep well at night and not even think about it. So just as I recommended with you, and I think you actually acted on this back when Bitcoin was, $15,000 or whatever it was, put 1% or, just dabble in it. The only wrong position in Bitcoin is to be on zero, to have zero exposure to it. But if you have 1% of your portfolio, heaven forbid, Bitcoin goes to zero, which I think we're beyond that as a risk. You've lost 1%, but this is an asymmetric trade where Bitcoin can still, to this day, go 100x. Okay, so 10,000%, 10,000% return. And so if you have a 1% allocation and you can tolerate that level of risk, then that can grow to be 50% of your net worth or portfolio in a very short amount of time. And every portfolio should have such asymmetric bets. And so that's Bitcoin. The rest of the cryptocurrencies are extremely speculative. You really need to know what you're doing. And I would be very, very careful and allocate extremely small amounts. And you're in Vegas, you're in the casino. And at this point, Paul Krugman is correct, and you need to be careful. And you're acting like venture capital in those type of situations. I think to have zero exposure to Bitcoin would be just as silly as having 100% allocation to Bitcoin. I think it's still important to be diversified through asset classes, to have protection from all sorts of risks, which include currency risk, because we're at that point where currency risk, although we've never experienced in our lifetime, is a real thing. And I think the debasement of the dollar is going to continue. So Bitcoin is not a store of value yet. It's volatile, but it's appreciating at 200% a year plus for the last 12 years. That is probably not going to stop. That's going to continue. And so, it's still very early. I think we're very lucky to have such a big pullback, although we'll get more. It's going to fall from $500,000 a coin down to $200,000 a coin, and people are going to say it's dead and it's over before it shoots up to $2 million a coin. This is the adoption of a monetary network. This isn't a stock that we're buying. This isn't a company with, who has a CEO that could have a heart attack or something like that. This is a whole new asset class that nation states are starting to adopt, that institutional money is flooding into. and that is growing in a very healthy manner. So that would be my final kind of statement about where cryptocurrencies should have a role in your investment portfolio. But of course, everyone is different and risk tolerances are different. And if you can't sleep well at night owning some Bitcoin and you're constantly checking the price because it's such a volatile asset, it's not worth the stress. At some point, there's things that are much more important than money, including your sanity and your happiness. So that's what I would say.
And my final question, any take-home messages that you want to leave with the Kevin MD audience?
Yeah, absolutely. I think if we zoom out to a 30,000 foot level, we all get so, kind of zoned in and interested in these things. And we're always so focused on making that next dollar and putting the kids through school and what do we need to do from a work perspective? And as physicians, we all suffer from overachieving and from working really hard. And I would say that philosophically, more than anything, more than investing, more than, find what your passion is, step back a little bit from whatever is stressing you out and take some time and really enjoy your passion, because you only live once as far as we know, and, it's really important to enjoy the people you love. And so, that would be my final recommendation is try and enjoy life as much as you possibly can, because it's a gift.
Noah, thank you so much for coming back on the show and sharing your time and insight.
Thank you, Kevin. It was great being here and sharing with your audience.